Welcome everyone to today's webinar on European listed real estate market trends for the first half of 2026, brought to you by Institutional Real Estate Incorporated and EPRA, the European Public Real Estate Association. It's great to have you all with us. Thank you for taking time out of your busy schedules to join us today. We really do hope that you will find today's session valuable. I'm Marek Handzel, the editor of Institutional Real Estate Europe, and I will be moderating today's discussion. Joining us today, we have three distinguished speakers. First of all, we welcome back Anna Escalante to the webinar. Anna is a property equity research analyst at Morgan Stanley. Secondly, we welcome Tim Kesseler to the panel. Tim is a senior portfolio manager at MN. And finally, as always, we have David Moreno, indexes manager at EPRA. Before we start, I will quickly outline a few house rules. There is a Q&A chat function where you can ask questions. Please ask questions as we go along. We may answer these both during the discussion or in a Q&A session towards the end of the webinar. If we don't have time to respond to any questions, please leave your name and we will get back to you and answer your questions before too long. We will be sending the slides from this webinar to all attendees, and this is being recorded so that you can listen back to it at your own leisure. A link to the recording will be sent to you after this. This webinar lasts for 1 hour. Okay, so hello Anna, Tim and David. Thanks for being here today and for taking the time to share your knowledge and insights with us all. Okay, so we're going to start today with David, who's going to present a few slides, which will come up on the screen shortly, on annual reports from 2025 and recent performance on a couple of EPRA's indices. So David, the stage is yours.
Thank you, Marek. Hello, everyone. Let me quickly share my slides. Just let me know when you can see them.
Yeah, I think they're coming up now, David. There we go.
Okay, perfect. So this is just going to be a very short background for the discussion. It's just to present some of the main trends and results. Around 5-7 minutes max. So here, as usual, we start by presenting some of the main trends in the corporate results that we saw at the beginning of the year. As you will see, basically, there was a story before March and after March. So basically, this was the main story what we saw at the beginning of the year, where most of the companies in developed Europe were releasing their annual results. And in general, the mood was quite positive. In 2025, many of the companies adapt to the new interest rates environment. Of course, many of them beneficiate from the interest rate cuts from the central banks, mostly in 2024, following the hikes we had before. And in general, what I could say is basically that most of the companies were quite positive in terms of the performance of 2025 and the expectations and the guidance for 2026. Many of them were actually showing interesting results in terms of growth, in terms of earnings, in terms of rental growth, in terms of leverage as well. Actually, few of them even releasing new plans for expansion, either into new markets or into new sectors. So basically, the mood was quite positive in January and February, when we start seeing most of the annual results, and even some of the quarterly results in the UK were also quite positive. So basically, the mood was strong at the beginning of the year. And then in March, where the conflict in the Middle East start, the results were still positive, but the guidance was much more prudent and the comments were less optimistic, of course, because uncertainty became the main rule. So when we saw the returns, the performance by sectors, as you can see, until end of February, all the sectors were positive in Europe. Actually, developed Europe was developing 11%, almost 11% return year to date as of February. And the top performers were residential, industrial, and healthcare, while self-storage and lodging and resorts and office were the bottom performers, but all of them were positive and actually was quite a strong performance at the beginning of the year. And then in late February, end of February, the conflict in the Middle East start, and then the picture changed. So of course, uncertainty became the main rule. It's very difficult to forecast pretty much anything right now because basically we're in the middle of the uncertainty with very high oil prices and news and geopolitical uncertainty every single day. And of course, listed real estate react to that. Very few sectors remain positive. Few of them turn negative and delete all the positive results that had until February. Net, the returns for the Developed Europe Index were 1% year to date. So basically, we are almost at the same level that December last year. And in general, what we could see is that basically some of the sectors that were proven to be more resilient in the last few months were still there positive, and some of them that had some additional volatility, especially lodging and resorts, were suffering quite a lot. So that was the main movement, and you can see clearly how the returns change from February into April. It's a completely different picture. In terms of the European developers and home builders, the story was even much more dramatic, especially in the UK, where you could see the performance of the Developed Europe benchmark was minus 20% year to date as of April. But actually, in terms of the performance for the Developed Europe ex UK, what you could see is that basically the performance was less affected, and the performance was actually positive. So in general, what we could see is that the developers in the UK, the home builders in particular, were suffering much more as a result of the uncertainty. The expected inflation and construction costs were affecting significantly this sector. And in developed Europe, in the Eurozone in particular, was less evident, basically because the interest rates were already at a lower level, and there was some additional support, especially in Germany, with the fiscal support coming from the government announcement in the last year. So in terms of performance for the developers and home builders, it's also a big different picture between developed Europe and the UK. And finally, just to make a short comment on this, good to mention that all these changes we have seen in the last few months, actually, you could see some of these elements and changes already reflected in previous shocks that we have seen in the past. And actually, we released a report in February covering the last 10 years of the listed real estate industry in Europe, when we could see some of the main changes after Brexit, the pandemic, the Ukrainian and Russian conflict. And that was quite a very good view for having a good background for understanding what is happening now and for opening the discussion today. So I invite you all to have a look at the report, and then I think that's a good background for kicking off the discussion today. So I will hand it back to you, Marek. Thank you.
That's great, David. Thank you so much. Someone has mentioned just before we carry on that they've had some audio issues in terms of an echo. If anybody else is struggling to hear us or feels there's an echo or some sort of issue with the audio, please do let us know, and we'll try and fix that. Yeah, so obviously 2025 was looking good, positive mood, as you say, David, and then everybody knows what happened. So, following on from those results, my first question would be, I'll maybe address it to you, Anna, is how are you sort of assessing the effect of the current environment and the conflict in the Middle East on listed real estate, particularly in terms of inflation expectations, sorry, and interest rates? And have recent events changed the way you're thinking about portfolio risk or exposure at all at present? What's your take on what we have at the moment?
Yes, and thank you very much for the invite and for hosting me again. It's always a pleasure to be here.
You're
Well,
very
yes,
welcome.
as David said, it is almost impossible to forecast things now, right? Because things change very quickly and every single day. I think that we need to take a step back, and in order to understand how this macro environment might impact property and European property, we need to understand first how it is going to impact macro variables such as economic growth or interest rates that, as you know, matter a lot for real estate, and particularly how the current situation might impact the long term of the curve. So our take is that if things normalize, like it looks like it's happening today with oil down and interest rates down, that could be a positive for the sector, arguably for many other sectors as well. But if you look at the numbers that David shared on the performance of the sector year to date, the sector fell more than other equities in March and is yet to recover. So a normalization of the environment could be a net positive for the sector, and it could make the sector rally above European equities. If the situation would extend for longer, and therefore inflation, rather than being temporary, could become a bit more sticky, we could argue that that will likely have negative impact on growth, and therefore long-term rates should fall, and that would be positive for some sectors, particularly the ones less impacted by economic growth or less correlated with economic growth. And I'm thinking on German resi, healthcare, students to some extent, while other sectors that are more correlated with economic growth and employment might suffer a bit more. So the question is, would rates go up even more from current levels? And if so, that would probably be negative for the sector. But if we think that interest rates and the long end of the curve won't go up more, then I struggle to see how the sector could continue to underperform. But again, this is really, really difficult to forecast. As I said today, it looks like we are seeing the light at the end of the tunnel, but I mean, who knows what will happen tomorrow? So in this environment, what we are seeing in terms of what investors are doing, and I'll let Tim talk about that because obviously he knows better than I do, but the feedback we are getting is that no one really wants to take risks at this time, and people are just waiting for things to settle down before making investment decisions.
Thanks,
Yeah,
Anna.
interesting.
Yeah,
I will
go
take
ahead,
up
Tim.
the analogy of the tunnel and the light at the end of the tunnel. It's more the question, how long is that tunnel? And yeah, what volatility comes on our path in terms of the geopolitical environment. And I think we as investors, we focus less on the directional rate moves and more on the rate volatility and the duration of the risk. So yeah, it's more that investors are, in my opinion, are looking for stabilization, no matter if the risks remain very high or will get lower again, but it needs to be stable. And I think also for listed real estate, the macro shocks mainly transmit through interest rates and financing conditions rather than immediately through the property level fundamentals. And I think for most of the companies in Europe, listed companies in Europe, those property level fundamentals are okay. So yeah, in general, I think we have a positive outlook on the listed sector in Europe.
That's good to know, Tim. Yes, I like the way you say, how long is the tunnel? Who knows? It's a very good way of putting it. David, do you want to chime in with any thoughts on what Anna or Tim have said so far?
Yes, thanks, Marek. Well, I think it's also, as both Anna and Tim were mentioning, depends of the duration of the uncertainty and the volatility related with that. So, for instance, what I've seen for most of the economists trying to understand how the inflation and the interest rates are going to be affected by the current situation. Basically, long story short, it depends of how long the conflict is to see how long-term impact would it have in the inflation. So if the current situation remains for more than 3 or 4 months, for sure there will be a much more important impact in the inflation at the European level, not only the Eurozone, but the UK, the Nordics as well, Switzerland even. And of course that's gonna push further for the central banks to hike interest rates at some point, mostly in the second half of the year. But of course, if everything continues calming down, and as we have seen in the last few weeks, the yields start decreasing, and the expectations in terms of inflation are also decreasing, with the oil prices also reducing, then that brings a little bit more stability. So we are only hoping for having a permanent deal in the Middle East that would allow to come back to stability, and then investors to have a better picture, a more clear picture in terms of what to expect, and then returning to more activity, and basically taking advantage of many of the opportunities that we have seen in the last few weeks in some sectors of the listed real estate industry. Actually, there are a lot of things happening, but not easy for the investors to take advantage of those situations, because the uncertainty is very high. And of course, to take a strong position on any specific sector is not an easy decision right now. So basically, we're just waiting for seeing some more stability, and then depending on that, the performance in the coming months is going to be much more positive.
Great, thanks, David. Yeah, Tim, I think you mentioned there in your initial comments that these are mainly first order effects, so financing conditions and interest rates, rather than on the fundamental real estate at the moment. But do you have any property sectors that are your favorite at the moment under current market conditions? I know Anna mentioned, I believe, German resi, healthcare, students, sort of sectors that aren't too tied to the economy, the economic picture. Is that your take there at MN?
I think so, yeah. We prefer sectors with structural demand and low obsolescence risk, and in some degree also pricing power. So, yeah, it wouldn't be a surprise that I would say that it's almost the same as what Anna mentioned. So modern logistics and residential in supply-constrained markets, and also, yeah, selected healthcare or long leased assets. So medical office buildings, senior housing, but also student housing. Those sectors would be the ones to watch.
Yeah, I think, as Tim said, it's also related to your question, Marek. It is not only the first order effects, which we all know, right? That if we get higher inflation, most companies will benefit from higher indexation, and that will help top line growth. Then we will also get higher financing costs, and will come through at different paces depending on the debt profiles. But then Tim mentioned logistics, right? If this conflict is going to endure more, we could assume that the different logistic tenants will adopt a more kind of strategy focused on building up inventories, just to built up some sort of supply chain resilience. And then we would be talking about nearshoring, reshoring, however you want to talk or to call it. We will also be discussing to what extent higher oil prices, which will mean higher transportation costs, will mean that these logistic operators will try to get closer to the end consumer to save time in transportation time, to save transportation time and transportation costs. And that could be beneficial for those landlords that own last mile or urban logistic warehouses. So it is very difficult to split one from the other, but clearly this is not only about inflation and how central banks are going to react. It's also what are the medium-term impacts of higher inflation in economic growth and tenant demand. And also looking at the cost base for the real estate companies, we benefit in general from being a sector that's capital intensive and labor light. Therefore, the initial rise in operating costs, such as utility cost or energy cost or wages coming from high inflation, should not impact these companies that much. That said, there are some sectors that are more operational than others, or some regions that, for example, Sweden, the landlord is responsible for paying energy costs that would potentially be more impacted just because of their more operational nature in essence, like student accommodation or self-storage, as opposed to other sectors that are less operational. So it is quite difficult to point to just one impact, because in the end, it's a more mixed scenario.
Yes, no, definitely. Thanks, Anna. Okay, before we move on to the next topic, we have actually received our first question, so thank you to whoever sent it in. Although it's not to do with what we're talking about right now, it's about AI. So just whoever asked that, just hang on, we will be getting to AI very soon. So just bear with us. Definitely a topic we need to cover today. Okay, so let's look at perhaps refinancing risk and debt profiles. There's been a renewed focus on balance sheets, obviously across the market. How would you characterize the debt profile of European listed property companies today in terms of sort of headroom, covenant headroom, maturity walls, and what have you? And from an investor perspective, this one's for you, Tim. Is refinancing risk a real concern for you now at the moment?
On a company level, yes. For the whole sector, I would say a bit less. I think the sector has done a great job in terms of the balance sheet strength. It's meaningfully stronger than in the previous cycles, and since the GFC. I think the debt maturities are generally also longer, and the share of fixed and hedged rates are also higher. So I think most companies, not all, but most companies have improved their balance sheets and also have enough or at least adequate headroom in terms of the covenants. Refinancing risks obviously still exist, but are concentrated and, as I said, very company specific, I would say. So yeah, that's you can argue that some countries even do better than others, and other sectors do better than other sectors, but it's mainly a company specific topic, I would say.
Yeah, I totally agree with what Tim said. I think that first, in terms of liquidity, there are hardly any company that is facing liquidity issues at the moment. Again, let's see how the macro environment evolves. But the first and most important point in terms of debt is access to financing, and so far markets remain open, and we've seen that. I think David and EPRA, they provide very good data on that on a monthly basis, and we've seen property companies in Europe continuing to raise capital. Then the question is at what cost, but at least markets remain open. And yeah, I totally agree with what Tim said, that there are some nuances in certain regions, maybe the Nordics, that have shorter financing and therefore are more exposed to refinancing risks, and certain sectors that have had traditionally shorter financing. But this is more of an earnings risk, I would argue, rather than a solvency risk. So we might see some companies that everybody thought that they were going to face interest cost and refinancing tailwinds rather than headwinds, and that changed after interest rates started rising again a couple of months ago. But our view is that would likely impact profitability rather than create solvency problems, because as Tim said, the headroom over covenants in general is quite ample. Property valuations that we haven't mentioned yet, but they have fallen in the last few years owing to the rising interest rates. So we are also starting from a more healthy level than maybe three years ago. So far things look okay. Again, who knows what will happen, but I would argue that so far the main risk is on earnings and earnings resilience in terms of how fast companies will absorb those higher interest rates, rather than any issues with solvency or liquidity or access to financing.
Yeah. I would say that's a very interesting point to highlight. I fully agree with Anna, and also as Tim was mentioning, at EPRA we look always at the big picture. We always try to see the entire sector, of course, different sectors, subsectors, and yeah, definitely it's very important to highlight that basically what we've seen in previous cycles, especially in 2022 when we saw the start of the Ukrainian conflict. The situation right now it's quite different. First, starting as Anna was mentioning, it's a much healthier level, and the interest rates are not as low as they were at the time. The economic growth the economic growth is different, and especially the input coming from the government. It's also much more positive now, especially in Germany. And the companies have adapted to the situation in the last few years, and also when you see how they were working on their debt profile, it's really good progress. And just to give you an idea, when the pandemic started in 2020, immediately, of course, as all the businesses were closed, and we were in very unusual circumstances, many of the companies had to take debt to continue operating. And the net debt to EBITDA for the general sector reached some very high levels that were not very common. It was very specific circumstances, reaching around 30 times net debt to EBITDA. And since then, they've been working on decreasing gradually that figure. And actually, we are very close to reach 10. That is the famous threshold for many of the credit rating agencies. And even some companies have already reached a much lower level than the famous 10 threshold. And the rental growth is there to support the higher interest rates. So indeed, the earnings is one of the biggest questions, because now the companies need to adapt to higher interest rates environment. And then if eventually the inflation continues increasing as we were mentioning before, and the central banks are forced to hike interest rates, then the companies need to react. And many of them are already aware of that. Many of them are already working on that, preparing their operational their operations and all the general structure to continue growing into a more in a context of higher interest rates and inflation. So generally speaking, what we have seen in the past is a bit different now, and what we have now is a much more resilient environment, and the companies much more prepared for the current conditions and the uncertainty that we have now. So generally speaking, we see quite a positive picture, and of course, it depends how it goes in the future. But so far, the sector looks very resilient.
Excellent. Thanks, David. Okay, we've had some other questions coming in. One about UK Resi, which we'll leave till later, I think. I think there's two that maybe we could answer combined together and maybe answer as one at this stage of the webinar, seeing as we're halfway through already, incredibly. So yeah, these are good questions, actually. So the first one is, do you consider NAV at the right level at the moment? Seems to have been very resilient despite the rise of interest rates during the last few months. And then there's another question, which is, how do you explain such a discount on NAV for listed real estate? For example, they mention, sorry about the pronunciation here, either Gesina or Gesina at minus 50%. So investors seem to not consider that values are so healthy. So a couple of questions there about NAV. Who wants to perhaps tackle those first? Anna?
Yeah, sure. I think that first question, whether NAVs are right or not, the issue with NAVs is that they are backward looking, right? That they are based on appraisals that were performed early in January and beginning of February with the information that we had back then. And both equity and also credit markets are much more react faster just by its nature. So I think it's all dependent on how the current situation might impact liquidity of direct real estate markets. We have already seen a slowdown in transactions in the first quarter of 2026. When we listen to what companies are saying, some of them are saying that they're still seeing opportunities in the market and seeing quite decent level of liquidity. Other sectors or the companies might say that there's still a bit of uncertainty and investors deciding to pause and wait until we have more clarity. So I think it is very much dependent on how the macro picture and the direct real estate markets will evolve from here. What we've seen in the past in terms of the external appraisers acting on valuations, they have always been more keen to act whenever the cash flows were at risk rather than when interest rates were moving, because as Tim said, in the end there is a lot of volatility in interest rates, so it's a bit pointless just changing and bringing values up and down given on what interest rates do on a daily basis. However, whenever there's been a meaningful risk on cash flows, that's where we have seen appraisers acting more quickly. So if, again, this conflict and the impact on interest rates proves to be transitory, at some point we should see liquidity in the markets coming back, and therefore NAVs shouldn't budge more from where they are now. If we start seeing real estate markets, direct markets, really drying up and a lack of transactional evidence, that's normally a sign of valuations at risk of falling. And in terms of why real estate companies trade at a large discount, there could be some discomfort with NAVs, but in the end, this sector has historically traded in the listed markets as a return on equity versus price to book, similar to how a bank trades. Banks that generate 20-25% return on equity, they trade at a premium to book. Banks that generate below that, they trade at a discount. And real estate companies are not different, right? If you think that if a real estate company that trades at book and trades at book during a 12-month period, the return on equity you generate is the same as your cost of equity, the same as the shareholder return. So for those companies that don't generate a return on equity that's sufficient enough for real estate equity investors, those companies will likely trade at a discount, because public listed equity investors will demand higher return to compensate for the risk. So it's not always that the market does not believe on their NAVs. It's also that sometimes the market places a discount on real estate companies that generate returns on equity or total NAV-based returns or total accounting returns, that we love jargon in the sector and we name things differently, but that are just not enough to appeal the equity investors that have a different cost of equity versus people that buy real estate in direct markets, right? There is not the same cost of equity for a pension plan, for a pension plan, or for an insurer, for private equity, or for public equity. Tim, what's your view on that? Are you very different from what we think?
No, I would totally agree. And I was actually suddenly thinking about an event by EPRA in London, together with Bloomberg earlier in April, where one of the UK REITs CEOs debated the V in NAV, asking if that value, the V, what is that V? Is that different between sectors? And I would even argue that if you look at, let's say, the retail space, values of retail assets came down significantly, and they have outperformed in the past 3 to 5 years quite significantly, and they traded below NAV, far below NAV, but they're now on par or even trading at a small premium. I have to look at David for the exact numbers, but that sector was, in my opinion, priced well. But if you look at residential, for instance, also large discounts to NAV, I wouldn't ask if it's priced well, because I think it's priced well because the supply in the sector is really low and the prices of the value of the assets remain high. But the interest of investors is lower. So I hope this call is also there's also a lot of generalist investors dialing in today, so we can tell them that the price of the assets is correct. So I would say the V is correct, and now the share prices should go up again.
Great. Thank you, Tim. Thanks, Anna. Okay, we do have a couple of other questions, but I think in the interest of time, we really should try and move on. We don't want to get bogged down in NAV, although it is obviously extremely important. Okay, so yes, as I said at the beginning, if you do have any questions that we don't answer today, we will get back to you if you leave your name for us. Somebody has left their name on one of the questions, so when you do ask a question, please do leave your name if you can, and we will get back to you as soon as we can. Okay. Yeah. Okay. So as I said earlier, we had a question about AI, and obviously tech disruption, AI disruption is a massive topic at the moment, and it would be remiss of us not to tackle it today. So let's turn to something very close to this, which is the halo concept, heavy assets, low obsolescence, which essentially sort of identifies companies that are less exposed to technological obsolescence. So which asset types or which sectors genuinely fit this definition today? And when do you think investors may be overestimating or underestimating obsolescence risk from the threat of tech and AI, if you like? Who'd like to maybe dive into that one first?
I think the halo concept is quite interesting. Heavy asset, low obsolescence. What comes in mind are the modern logistics facilities. Obviously, in a well and good location, but especially the modern logistics, I would say, being capable of generating their own electricity, the EV trucks. I think going forward in the future, it's of paramount importance that these assets remain and that they're attracted by investors, but also larger residential platforms. If you see the average age of first-time home buyers, if you see the average size of the households in Europe, the aging population, the structural demand for residential assets remains very, very high. So I would say those ones are the first and foremost important ones. And I think your second question was on the underestimated risks. I would say the obsolescence risk in offices is probably still a bit underestimated. But also there, I want to make a divide between the top tier A, the grade 1 offices in the best locations versus the offices in the peripheral locations. I think amenities in offices will be very important, and it needs to be on hubs of public transport. And that would, for me, also say that that's a halo asset. But it's the divide between the top tier A offices being very, very halo, so to speak, and the tier 3 office assets being no halo.
Or a hay with that, but with a small cap, lower cap low, right?
Exactly.
And Tim, I hope you agree with me that we are lucky to have lots of those in the listed sector, right? That most of listed companies in Europe that invest in offices, not everyone, of course, but in general, we benefit from them having quite prime, well-located assets, and therefore, maybe that's one of the reasons why they have derated less than some of their US counterparts, because the prime nature of its portfolio makes them more resilient to this AI threat. That I totally agree. I think that the big topic here is how AI might reshape employment and therefore offices. So some people might argue that AI will create net job losses and therefore that will result into lower demand for office space, all else equal. But then we also hear the point that Tim made that will result into an even further polarization and demand focusing even more than already is in the best of the best assets. So again, it's quite difficult to forecast what will happen, but those are the debates that we are having the most at the moment. And then on the other side, which sectors are more resilient? Of course, residential and especially affordable housing, it is difficult to get more halo on that. And then, of course, senior housing, care homes, that's quite defensive. And then other sectors are just in the middle, right? Like student accommodation has historically perceived to be quite resilient or quite uncorrelated with economic growth, even negative correlation with economic growth, right? If employment is declining and unemployment is going up, then you might do another year of a master rather than trying to find a job. But then we are also hearing the view that if graduate hiring is now suffering from AI already, maybe the value of a university degree will decline in time because you are no longer seeing the benefit of spending that much money in studying in a higher education, and therefore, what would the net impact be? Again, difficult to forecast, but indeed a very, very interesting debate.
Yes, no, definitely. David, any views from EPRA on AI disruption? Particularly, actually, maybe do you think some of it's more hype and narrative and sort of rather than reality? Do you have a firm view there at EPRA?
Yeah, absolutely. On our side, of course, we try to have a look at the big picture, and then what we have seen is a strong and huge potential for improving efficiency on the capital and especially on the property management angle. So just to give you a couple of examples, before on the student housing properties, in many times years ago, you have to wait for the student to leave the room to see in what status the room is after he left or she left. Now you can monitor exactly on a daily basis how it's evolving, and that type of situation happens with many of the tenants in many different types of properties. Now you can control all the movements in the retail facilities, in the warehouses, in the office buildings. You can check what's the current situation of the building, and you can take a much more preventive operational risk management and capex management. So you don't need to wait longer time for starting to fix the small details in the property that they usually require a lot of work when they start accumulating, and then you need to spend some significant capex. and cash from your operations, just to keep the properties on a good shape and operational efficiency. So actually, the AI is allowing to have real data in many parts of the property management process, that it's actually incredible how this can increase the operational efficiency of all the companies, and not only those sectors that are considered highly operational, like healthcare, student housing, social housing, but also the other sectors that were less operational. And basically, in the story we have until basically 2022 was low interest rates, yield compression, and then you add value on your operations. Now that you don't have yield compression anymore, then the operations are becoming much more important, and the differences between the companies are actually on that front, and how you can use the AI to improve your operations, to reduce your costs, your expenses, your CapEx. So in the end, the AI is a very huge opportunity for the entire sector, and what we have seen is that many of the companies are already investing a lot on AI and getting on the wave of how to use this new technology for improving their operations. So on our side, we're quite positive on that front.
Yeah, I think you're absolutely right, David. I think that the companies in Europe went from sort of defensive deleveraging, looking at the LTVs and the NAVs, towards earnings-driven growth. And that earnings-driven growth in current financial circumstances is not as easy as it used to be with the very low interest rates, but it has to come from efficiency, from a platform, from well-managed assets, but also a well-managed company. So I think David is spot on in that regard.
And then we
And
also
that
have,
drives.
yes, of course. And I was going to say that let's not forget that we also have some sectors that are super AI related, like data centers. Even if that's small, those are a clear beneficiary of this AI theme, and that they will be essential in facilitating and enabling AI across Europe.
Yes. No, all very good points that you've made. Yeah. Okay, let's quickly move on to looking a little bit about value creation. Then we'll go into the Q&A, try and answer some of the questions we've had today. So, as I understand it, there's been an unprecedented number of new CEOs in some of the companies in the sector, and they're looking to do something different in terms of value creation. So, in terms of creating value for shareholders beyond just obviously trying to have a recovery in asset values, what strategies do you see as being the most highly effective that are being employed by REITs across Europe at the moment?
Should I take that first?
Yeah, go for it, Anna.
Well, I think that the narrative in the sector was survive until 2025, because we all thought that by the end of last year, we were going to have interest rates going down, and therefore, if you managed to survive till then, everything was going to be fine, and you didn't have to make any bold decisions, because sometimes, you just wait and expect better times to come. Then, for all the reasons that we have already discussed, that did not happen, and a lot of boards and investors really were fed up of the situation and pushed management teams to start doing things. There are some management teams and some companies that can do things in terms of offensive strategies, like invest to grow. And there are other companies that are more capital constrained, and therefore they are more limited on what they can do, but they can always do things. And we've seen first an unprecedented number of CEOs starting in European property companies this year, and also some companies trying to do some sort of self-help strategies, like selling assets to buy back stock, as we have already discussed. That would make sense when you are trading such a wide discount to NAV. You crystallize some of your valuation in the direct real estate markets, and then use that capital to invest it in a highly accretive thing such as your shares. While we've seen other companies that are now still adopting the same view that they had 2 years ago of just wait and see. And normally those are the companies that are being penalized by investors, while they favor these companies that are in a privileged position that they can invest to grow, or that are taking the initiative to do things and try to build a little bit self-help story.
Anybody else want to come in on what Anna said there?
I totally agree with Anna, as usual. And it's all about the operational execution that matters more than the expansion in this phase of the cycle. So management teams really need to do things. They cannot sit and wait, as Anna mentioned, wait until 2025. Now it's 2026, and the market hasn't substantially changed. Well, it changes on a daily basis, but not from a year ago. Inflation remains high, interest rates remain high. So yeah, do something. Sell assets, buy back shares, and drive your earnings.
Excellent. Okay, so we've got 10 minutes left, so let's dive into a couple of these questions if we can. So there's two questions that maybe we can again try to merge. The first one is, what is the panel's view on UK residential, considering building costs, major developers having a pause in their pipeline, political discontent, fiscal pressures, and possible new rental legislation, to mention but some factors. And then the other question around the UK is, okay, yes, so from Giuseppe is, do you see the 30-year gilt yield? The 30-year gilt yield hit 5.787% yesterday, the highest since 1998. So the 30-year government bond yield there in the UK. Is this a genuine macroeconomic shock or just a blip? And what is the impact on the housing market in your view? So we could sort of try and marry those together if we like. Yeah, UK Resi. Any thoughts on UK Resi from your side there, Tim?
I would start with the question on the 30-year gilt.
Okay, yeah.
A shock or a blip? I would say it came gradually, but then it was there suddenly. It is what it is. But if we take that together with the difficulties in building new supply, and I don't think that's purely a UK problem, but it's the same in the Netherlands and throughout Europe. I would say that we need to urge politicians that they need institutional capital, REITs funded by international institutional clients like our clients, the pension funds in Europe and other institutional clients, that they can be part of the solution. If they lift their difficult laws and difficult rules and regulations, I think those institutional investors are there to put in the money. So I think it's more of a political debate than a pure financial debate. And it's something that needs to be addressed on a higher level in the parliaments of the European countries.
Interesting. Yeah. Anna, any thoughts?
Yeah, I think that, well, first of all, on making forecasts for UK bond yields, I mean, I'm not an economist, that's a little bit above my pay grade, but what I can say is that we are in an election week. We have local elections in the UK tomorrow, and there's always, peak uncertainty, or it has tended to be peak uncertainty just ahead of the election. So clearly, we should have more clarity from tomorrow or from Friday. So let's see what that takes us. In terms of UK housing, I think that UK house builders will likely continue to suffer in this environment. because, as Tim said, in the absence of a more favorable regulation and incentives to construct, we will see that volume recovery will be pushed to the right. In terms of build to rent or the private residential market in the UK, we just got this new law that came into play, the Renters' Rights Act, that could have multiple impacts that we are yet to see. Clearly, residential in listed markets, especially regulated residential, which is was not the case in the UK, and now it's becoming more the case, is a lower yielding, lower return asset class, but it's also quite defensive and quite halo. So if we were going to see the macro worsening and hopefully not, but Europe going into a hard recession, residential would be the place to hide. And also, if you're looking for something that's supposed to be, or that's AI defensive and halo, then, as I said before, residential is the place to be. But on the other hand, with interest rates where they are, it is very difficult to make it work from a return perspective.
David, do you have any thoughts on that topic?
Yes, just a very short comment. Basically, I remember when a couple of years back when we were discussing in this webinar as well the current trends around the world, and basically we were mentioning that there was something kind of funny, one of the events that was repeated a few times, that basically was mentioning that the US innovates, China replicates, and Europe regulates. So actually, what we have seen in many cases is with over-regulation, too many rules, making difficult for investors, for the households, for everyone to adapt to the environment. And actually, we've been working very actively. EPRA has a specific team dedicated to the housing issues across the continent, not only in Europe, well, not only at the European Union level, but also in the UK and all the other regions, because basically it's continuously one of the biggest challenges that we've seen at the continental level for all types of investors, but for sure for generalist investors as well, and for foreign investors from all countries to invest in Europe. So for sure, the over-regulation is still one of the big issues to fix in Europe, and yeah, at least on our side, we're already working on that.
Great. Okay. We've got 3 minutes left. How about we do one more question from an anonymous attendee? You haven't spoken about retail yet. How do you see the performance of this segment looking forward? Talking about, the questionnaire mentions resilience during and after COVID, the energy crisis, impacted by e-commerce, and during recent years has booked an interesting total return. So what's your view on retail? Quick 1 minute answer from you all, if we could, please.
For us, it's more kind of middle of the pack, because we've seen e-commerce penetration rising again. So basically, e-commerce penetration started to rise in the middle of the 2010s, and that really hurted the performance of the share prices of listed real estate retail companies. Then after the pandemic, there was some digestion of that, and people went back to the shop, and therefore retail names outperformed. Now let's see, right? We are a bit kind of, again, less positive about how they will be able to endure this outperformance, because we think that e-commerce is set to rise and continue rising again, particularly in continental Europe, where penetration is lagging 4 or 5 years UK behind the UK. So yeah, not that positive, but not super negative either.
Tim, any thoughts on retail?
I think I'm somewhere in the middle. Some experts say that e-commerce penetration is now at its height. Some say it can grow even further. I think retail has done a phenomenal job in the past years. Yeah, I'm neutral. Yeah.
David?
Well, for us, it's always the way how to support the sector. And what we have seen is that the e-commerce penetration is definitely one of the top priorities for the sector. And it's completely different depending of the regions and the countries. Yes, so of course, depending on the specific market you are looking at, you will see strong differences. But for sure, continental Europe, it's a bit behind the Nordics and the UK on that front. And so there are a lot of interesting opportunities on that front as well.
Excellent. Okay, we've reached the hour mark. It's flown by as usual. Hard to keep up with it all, but there we go. Thank you so much to you, Anna, to you, Tim, and to you, David, for participating today. It's been really great to have you on. And thank you everyone for joining this webinar, brought to you by Institutional Real Estate Incorporated and EPRA, the European Public Real Estate Association. As I said at the beginning, we will be sending a link of the webinar to you after this. And we will, if you've left your name with your question, we will endeavour to get back to you with an answer as soon as we can. For now, thank you, and look out for the next one over the next few months. Thank you very much, everybody.
Thanks
Thank
for
you.
having us.